Compound interest is often hailed as the eighth wonder of the world, a phrase attributed to Albert Einstein. The idea is that by reinvesting earnings, your money grows exponentially over time. However, in real investing, this theoretical miracle rarely works as advertised. The promise of compound interest is seductive: leave your money alone, and it grows exponentially. Albert Einstein supposedly called it the eighth wonder of the world, and financial advisors repeat this endlessly. But here's the catch: the math assumes a smooth, uninterrupted growth path. Real investing is messy. Markets go up and down, taxes take a bite every year, and fees chip away at your principal. The result is that the actual return you earn is often far below the theoretical compound interest calculation. For example, if you invest $10,000 at a 10% annual return, after 30 years you'd expect to have about $174,494. But if you pay 20% in taxes on gains each year, your effective return drops to 8%, leaving you with only $100,627. That's a significant difference. The promise is real, but the conditions are rarely met, making the miracle more of an illusion in practice. Taxes are the first silent killer of compound interest. Every year, capital gains, dividends, and interest are taxed, reducing the amount you can reinvest. Consider a portfolio earning 10% annually. If you pay a 20% tax on gains, your effective return drops to 8%. Over decades, that 2% difference compounds into a massive gap. For instance, on a $100,000 investment over 30 years, an 8% return yields about $1,006,266, while a 10% return yields $1,744,940. That's a difference of over $700,000. The math is simple: the more you pay in taxes, the less you have to compound. Tax-efficient accounts, like retirement plans or tax loss harvesting, can help, but they don't eliminate the drag entirely. Understanding this leak is crucial for investors who want to maximize their long-term wealth. Let's quantify the tax drag. The formula is straightforward: your after-tax return equals your pre-tax return multiplied by 1 minus the tax rate. For a 10% pre-tax return and a 20% tax rate, the after-tax return is 8%. The difference may seem small, but over 30 years, it compounds into a significant shortfall. To validate this, you can compare the growth of a taxable account versus a tax-deferred account over the same period. For example, if you invest $10,000 at a 10% pre-tax return for 30 years, a taxable account with a 20% tax rate would grow to about $100,627, while a tax-deferred account would grow to $174,494. That's a difference of over $70,000. If the tax-deferred account doesn't show a meaningful advantage, your assumptions about tax rates or returns may be off. This formula highlights the importance of tax planning in investment strategy. Fees are the second silent killer of compound interest. Management fees, custody fees, trading commissions, and sales loads all eat into your returns. A 2% annual fee on a 10% return might not sound like much, but over 30 years, it can reduce your final portfolio value by about 40%. That's not a typo. For example, on a $100,000 investment earning 10% gross, after 30 years you'd have $1,744,940 with no fees. But with a 2% annual fee, your net return is 8%, leaving you with $1,006,266. That's a reduction of over $700,000, or about 40%. The higher the fee, the more it compounds against you. Low-cost index funds have become popular precisely because they minimize this drag. The lesson is simple: every dollar paid in fees is a dollar that can't compound for you, so minimizing fees is essential for long-term growth. The fee drag is easy to model. Your net return equals your gross return minus the fee. For a 10% gross return and a 2% fee, the net return is 8%. Over 30 years, the difference in terminal wealth is substantial. To validate, compare the growth of two identical portfolios, one with a 2% fee and one with a 0.2% fee. For example, a $100,000 investment at 10% gross with a 2% fee grows to $1,006,266 after 30 years, while with a 0.2% fee, the net return is 9.8%, growing to $1,632,980. That's a difference of over $600,000. The gap should widen over time as the fee drag compounds. If it doesn't, your fee assumption or return projection may be incorrect. This demonstrates why even small differences in fees can have a huge impact on long-term wealth, making fee minimization a critical part of any investment strategy. The most insidious killer of compound interest is volatility. The compound interest formula assumes a smooth, constant growth rate, but markets are anything but smooth. Consider a portfolio that gains 50% in year 1 and loses 30% in year 2. The average annual return is 10%, but the actual cumulative return after 2 years is only 5%. That's the volatility drag. The higher the volatility, the bigger the gap between the theoretical and actual returns. For example, if you invest $100,000, after year 1 you have $150,000, but after year 2 you have $105,000, which is only a 5% cumulative return, not the 10% average. This is why professional investors focus on risk-adjusted returns, not just raw returns. Volatility can silently erode wealth, making it crucial to manage risk through diversification and other strategies. The volatility drag can be quantified. The compound annual growth rate, or CAGR, is approximately the average return minus half the variance. Variance is the square of the standard deviation, a measure of volatility. So, higher volatility reduces your actual growth rate. For example, if a portfolio has an average return of 10% and a standard deviation of 20%, the variance is 0.04, and half of that is 0.02, so the CAGR is approximately 8%. To validate, you can calculate the CAGR of a volatile portfolio and compare it to the simple average return. The difference is the drag. If the drag is larger than expected, your volatility estimate may be off. This formula shows that even if two portfolios have the same average return, the one with lower volatility will have a higher CAGR, leading to greater wealth over time. Let's compare two portfolios. Portfolio A grows smoothly at 10% per year. Portfolio B has the same average return but alternates between plus 20% and 0%. After 2 years, Portfolio A has grown by 21%, while Portfolio B has only grown by 20%. The difference seems small, but over longer periods, the gap widens dramatically. For example, over 30 years, Portfolio A would grow to $1,744,940 on a $100,000 investment, while Portfolio B, with alternating returns, would grow to only $1,610,510. That's a difference of over $130,000. The smoother the path, the closer you get to the theoretical compound interest. This is why diversification and risk management are crucial. By reducing volatility, you can achieve more consistent returns and harness the full power of compounding. This chart shows how volatility erodes long-term growth. The blue line represents a smooth 10% return, while the red line shows a volatile portfolio with the same average return. Over 30 years, the smooth portfolio ends up significantly ahead. The gap is the volatility drag. For example, on a $100,000 investment, the smooth portfolio grows to $1,744,940, while the volatile portfolio, with alternating returns of plus 20% and 0%, grows to only $1,610,510. That's a difference of over $130,000. The gap widens over time, highlighting the importance of consistency. It's not about picking the highest return, it's about achieving the most consistent return possible. By focusing on risk management, investors can reduce volatility and allow compound interest to work more effectively. To see volatility in action, look at the CBOE VIX, a common measure of market fear. As of mid-August 2026, the VIX sits at 14.25, down sharply from a month ago. This low level suggests investors are relatively calm. But calm periods don't last forever. The VIX has ranged from 14 to 23 over the past 3 months. This reminds us that volatility is always lurking. The theoretical compound interest assumes a smooth path, but the VIX shows us that markets are never truly smooth. For example, a sudden spike in the VIX can indicate increased market turbulence, which can lead to larger drawdowns and slower recovery. This is why it's important to prepare for volatility by maintaining a diversified portfolio and avoiding overconcentration in risky assets. Understanding current market conditions helps investors set realistic expectations for their returns. So, what actually makes compound interest work? It's not high returns. It's low volatility, low fees, and tax efficiency. These three conditions allow your returns to compound with minimal leakage. High returns are great, but if they come with high volatility, the drag can wipe out the benefit. Similarly, high fees and taxes can silently eat away at your wealth. The key is to focus on what you can control: costs, taxes, and risk. For example, by investing in low-cost index funds, you minimize fees. By using tax-advantaged accounts, you reduce tax drag. And by diversifying your portfolio, you lower volatility. That's the real secret to building wealth. It's not about finding the next hot stock, it's about creating an environment where compound interest can work its magic over the long term. Compound interest is not a myth, but it's not a miracle either. It's a conditional promise. It works only when you control the three leaks: taxes, fees, and volatility. The math is clear: a 10% return with a 20% tax rate leaves you 8%. A 2% fee drops that to 6%. And volatility can shave off even more. For example, if you have a 10% average return but high volatility, your actual CAGR might be only 6% or less. The result is that the theoretical eighth wonder often becomes a practical illusion. But by focusing on low costs, tax efficiency, and risk management, you can turn the illusion into reality. Thanks for watching. We'd love to hear your thoughts on how you manage these three leaks in your own portfolio. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.